Hello, everyone, and thank you for joining us today for the IRS updates that we just received last Friday on August 28th. We're going to unpack the updates and share the new 941 form that they have proposed. It's still in draft mode as it relates to the tax deferrals from the President's executive order on tax deferrals. So my name is Mike Connolly. I'm the head of marketing. Joining me today is Terry Kirby from our tax filing compliance group at Assure. Welcome, Terry.
Hi, thanks.
So before we jump in today, just want to kind of share our strategy and what we want to talk about. So as many of you guys know, we talked about before, we are members of the NPRC, that's the National Payroll Reporting Consortium, where Assure, along with other industry leaders, work with the NPRC to lobby and consult with Department of Labor, IRS, Treasury, et cetera, on how best to implement laws. And there's been a ton of them, obviously, this year with FFCRA, CARES, and now this executive order that we're trying to all figure out how to implement, right? So I want to be cautious. We're going to give you the very best advice we possibly can. Terry's, we won't say how many years, Terry, but between, I think, the two of us, we are many, many decades in the payroll business. Terry is an active member with the NPRC, sits on weekly meetings and all the conference calls with the industry leaders. So we want you to know that we do feel like we're speaking from a position of authority, and we know what the heck we're talking about. But we are also speaking from a position and advocating for small businesses. We are not your lawyer. We are not your accountant. We're not your bank. And so a bit of a safe harbor statement. We really want you to not treat this as legal advice, but we are advocating on small businesses' behalf. And we're just simply sharing our best opinions. So please don't mistake this for legal advice, legal counsel, but do interpret this as someone who has your back and is thinking about how do we help small businesses survive these crazy times, so when we get out the other end, we can all begin growing again. So with that, I'm going to jump into our topics. And so first, kind of recap. I think most of you guys know, if you were on previous week's webinars, we'll briefly recap the President's memorandum on deferring payroll tax obligations, aka the executive order. And we're going to dive into what it was, still is, but also some of the updates that we got. So Terry, if you could maybe just kind of recap for us real quick, the major bullet points before we start jumping into the updates, but the main points really haven't necessarily changed, at least from 20,000 feet. Can you kind of explain to everybody what the major bullets are?
Sure. With the President's memorandum on August 8th, they basically were looking to have a payroll deferral available to employees so that they could defer their Social Security portion to a later date, so that their paychecks from September 1st through the end of this year could have that amount deferred and not necessarily withheld, but then they would have to repay at a later date. It does not include the Medicare portion per the way the information was provided, and it doesn't really indicate anything with regards to the employer, because we've already got the employer's deferral with CARES Act and FFCRA. So at this point in time, it didn't change. Even with the guidance, we know that the period that they're looking at is paychecks received or paid after or on September 1st through the end of 2020. The tax deferred would mean that while the employee is not having that tax withheld at this time, there would be no penalties and interest for the repayment as long as it's at that point in time, which would be futurely disclosed. And then they had generally identified that the wage in question would be for an employee that received the equivalent of $4,000 on a biweekly period or less. So anybody that received more than that would not be eligible for the deferral.
Yeah.
So you can see from these bullet points, nothing much has changed.
So we regrettably we got an update, but it might lead to more questions and answers. We kind of redlined the word generally, obviously, because we did get a little more clarification here. So one of the things we talked about a week ago is how Assure being represented by and participation with the NPRC. NPRC then partnered with American Payroll Association, and basically after we got the memo, the original memo on the 8th, on the 14th sent a letter to the Treasury basically saying, hey, we got a bunch of outstanding questions that need clarification before this executive order could be implemented, right? We get it conceptually what you're going for, but before you can begin programming software and actually implementing rules and having tax returns be filed accurately and correctly without people getting penalties and notices, we need some answers. So the good news is we got some. The bad news that just want to be as transparent as possible. I don't think this is just an Assure opinion. I've seen plenty of documentation and talking to other people in the industry, in our peers at some of the national players. There's no way, and this is my opinion, but there's no way anybody could have enough clarification to actually begin to fully program software, right? So I think Assure and everybody else, we are preparing our systems. We are doing some programming in preparation, in anticipation, knowing what the end game is. But there's no way anybody's gonna be able to finalize without some further guidance. We assume that there are going to be a series of releases to guidance, right? Of Q&As and interim interpretations. But we're going to need something more material than probably this, what we got on Friday, before people can then finalize their systems. So at least, Terry, maybe talk us through what I think, in my mind, there may be a little bit more here, but there's the big four here, right? When is payment due? What are applicable wages? What are the pay thresholds? And then kind of a biggie that we're going to talk a lot about today is there's, who's ultimately responsible. Can you just kind of put a little color around these four bullets for us?
Sure. With the guidance that came out on Friday, the Treasury and IRS Chief Counsel was able to indicate that at this point in time, the repayment of the deferral of the employee Social Security would be due from January 1st, 2021 and ending on April 30th, 2021. Before they would have any assessment. So if an employee did have deferral and did not repay, May 1st going forward, they could be exposed to penalties and interest. That is a concern. The memorandum does indicate that it's applicable wages that would be paid September 1st through December 31st. That means that these wages are the $4,000 on a biweekly period or less. They also indicate that these are wages that would be subject to Social Security. So in most cases, that's the employee's gross less their prepaid Section 125 plans. But we need to keep in mind that those are specific types of wages that would qualify the individual for that $4,000 equivalent, or for whatever the pay period the equivalent would be. And we just hit into the second one, because the pay threshold being that less than $4,000 on a biweekly pay, that's the applicable wage threshold. And then, of course, that would have to be, extrapolated to the pay period that the individual employer is using. And so the examples are on the screen. The interesting part on the whole thing is that while the employee is having this deferral, the repayment plan indicates that the employer would be responsible for collecting it from the employee to remit it to the agency in that January through April period. And that's where some questions come up, because the employer then becomes responsible for remitting that additional tax in addition to the normal withholding to the agency.
And we're going to beat the heck out of this topic, but it's almost like, so like bullet 3, the pay thresholds, I wouldn't even say ambiguity. Maybe we need a little bit more clarification, and we'll talk about, people whose pay fluctuates. Maybe it's a commissioned salesperson whose pay may go above and below on a pay period basis, that 4,000 mark, or hourly work where maybe overtime one pay period, not the next, or construction, I got hours this week, didn't get hours the next. Those are kind of mathematical things I think to work through, but this fourth bullet is really the biggie that begs, we're going to go through 10 more questions, but 50 more questions. Would you kind of agree with that, Terry?
Totally. Yes, very much so. Because even with the pay thresholds that we're talking about, the information with guidance pretty much indicates that it's evaluated on each paycheck, if you would, that the individual gets. So I might get a paycheck this week or this biweekly period that's less than 4,000, and I can have my Social Security deferred. But in the next pay period, I could have $4,010, and then I can't have any of that deferred because I've exceeded the limit. So it could be for some of those employees, they go over and under. There could be pay periods that I hit it and pay periods that I don't. The other part with the responsible to pay challenge is that how does the employer collect those funds now from the employee in order to remit them? Do they come through their paychecks? Do they come from the employee's going to write me a check and I'm going to put it into my account? Those are challenges.
Yeah, and I won't try stealing too much thunder here. That's really going to be where we try to explore and get some clarity here. So, but those really are the big updates. Applicable wages, pay thresholds, payment period. Those are really important things that we're missing from the original. But I think we should put one stake in the ground here. Who's responsible to pay? And I'll come back to a second. On paper, therefore, I think the letter of the law would say it's the employer. So we don't want any ambiguity about this. There's tons of ambiguity on how you're actually going to be able to execute that. But it is for sure on paper.
Correct.
Yeah, IRS has said, Treasury has said it's the employer. They have not provided, there's plenty of ambiguity in how to do it and pull it off because it seems impossible to us. But they've not given any ambiguity that it would be the employee who's responsible. Okay. We also, in some of the updates, not in necessarily Friday afternoon's guidance update, but in a side parallel track, they have published a draft version of the new 941. So can you just kind of, we'll jump next slide and kind of talk through the two fields, but you want to just take us through the high level, the 2020 evolution of the 941?
Sure. Third quarter change for the 941, basically they did not add any new fields, but they did change and repurpose two lines. Additionally, they've kind of modified another line. We're still waiting for instructions to give us exactly how this is going to work. But at this point in time, we know that, because from what information we have, we're still going to be looking at obtaining the total Social Security wages and the total tax liability. So the first page of the 941 has relatively not changed, but again, there's still questions because that deferral. On the second page, they actually have changed line 13B that used to only indicate the employer deferred Social Security from quarter two, which is now going to be the total Social Security deferred. So the employer portion, if the employer is participating in that process, as well as the employee's portion. And then on the third page, lines 24 and 25 used to be there for first quarter employee retention credits that were for that March period. The employer was only able to use the second quarter 941 to claim those. And so now at this point in time, they would have to amend their second quarter if they wanted to address that. But these lines are being repurposed. Line 24 is now going to reflect the amount of the employee share of the tax that's being deferred so that we know what the employee portion is. The employer portion, the sum of the total would be 13B. And then line 25, which was for the qualified employer health care for the employee retention for March, is basically just a not being used line for this point in time. So a lot of repurposing.
Yeah, Terry, do me a favor. So we have well over 1,000 people on today's webinar, and so a lot of people are going to be deep in the policy world here and are tracking with you. I think the lion's share are going to be entrepreneurs, business owners of small, medium-sized businesses who they know the 941 quarterly payroll tax return is. But this is pretty wonky stuff. Can you kind of just really simplify of what, because part of this ties back to, correct, tell me if I'm wrong, I think it's FFCRA, not CARES, about how certain types of leave and or maybe it's CARES about certain tax deferrals that were available to the employer, and how a Q2 return had different requirements for, or maybe Q1 or Q2 return for March for that law, which is now then different for what we're trying to accomplish here in Q3. I almost confused myself asking the question.
Understand that. Sure. I think what it is that because of when CARES went into place, I think it was like March 27th, we needed to consider the employer taking on the employee retention credit for those last 2 weeks in March. And so that's what lines 24 and 25 were used for second quarter. Granted, the employee or the employer can still use the employer retention credit. Those are on other lines for the 941 for the current quarter. The item is that I can't take my first quarter and throw it onto my third quarter return or my fourth quarter return. The agency wanted it always to be on that second quarter return. So while the employer, the FFCRA with our sick and family leave is still in lines 5AI and 5AII, which is the Social Security portions, and we still have the wonderful worksheet that created a lot of confusion just in how to calculate back some of the other credits that are applied. Those are still in place and haven't been changed. The only item that really has been addressed or changed, added to, modified, if you would, is the piece that had with the employer Social Security deferral. The presidential memorandum is now allowing the employee to have his Social Security deferred. And so the impact is the change on these two lines so that we can report it and know, we know now what the employee portion is. We'd be able to identify the employer portion on the 941 so that when they're validating back your liabilities, the Schedule B, if you would, to the total deposits and then the deferral amounts that should be paid in future, we'll be able to identify where those pieces, parts came from on a quarterly report. Ultimately, the employee portion, like for a deferral, we're assuming, and we're waiting for further information, would probably also be reported on W-2 so that then we can say, here's the employee portion of deferral total for the year should equal the sum of the 4941s and it would only be third and fourth quarter since it was only available then. And we could be able to reconcile all of our returns to the W-2 pieces. And then the employer portion is referred back to also looking at the W-2 information, but it goes a little bit further because we had the employer deferral available from second quarter.
All right, so
that made it even worse, huh?
No. So I think you said it about as succinctly as you can. I think just the reality is this is damned complex, right? And so
Definitely.
I think we need to guide entrepreneurs, small business owners accordingly. This is hard, and not only is it complex, it's fluid and ever changing because this, you can see it. This is a draft not even final from the IRS. Okay, let's move
Correct.
on to some of the questions that I really think we need to address today. And what we did here, guys, is we kind of put this into two different buckets. We got a bunch of questions for employers and for employees. The intent here, I'd say the front half of this for the employers is we want to give you guys, we want to arm you guys with the intelligence to make as good a decisions as you possibly can about how, how, when you implement this on behalf of employees. If for no other reason, to at least understand what your risk is and what your liability is. We are not, go back to our safe harbor. We're not telling you you can do it. We're not telling you can't do it. We're not telling you have to do it. We're not telling you it's optional. You're going to find out in question number 1 why our position is on that. But we want to arm you with at least as much knowledge as you can to understand the risks and what your potential liabilities are. The second half for the employees, really just we're just making the assumption that you've got employees who watch the news and talk to friends and heard about this thing that I don't have to pay my taxes starting September 1st to then, regardless of how you choose to proceed, to then arm you for those conversations. So with that, let's start out with the employers. In the $1 million question here, do I have to participate, Terry?
Well, here you go. This is the question of the day for the most part. According to the legislation and the actual presidential memorandum, it doesn't even go near the fact that whether the employer can opt in or opt out. It sounds, from the verbiage, it sounds like if an employee inquires, you may, as an employer, have to provide that. Here's the caveat to that. Because there's so much ambiguity and we don't have enough information on exactly how this is going to be managed and how we would set up the programming, a lot of employers have opted to say, until I get that information, I am not making this available to my employees. Additionally, with other legislation that says, hi, the employer is responsible to always withhold and collect, because this really doesn't forgive that responsibility. And as you'll notice, it kind of tacked it on until 2021. The employer still may be on the hook for that withholding, and so he may opt to not want to participate in that. Do we have to? We don't have all the answers on that one yet, and that's still one of the questions that we've been posing to the Treasury and IRS Chief Counsel, because we don't have enough information to say you must or you must not. And so that is part of the questions that NPRC and the APA forwarded to the Chief Counsel.
And so this is my opinion and my 2 cents, not legal advice. It's this impossible conundrum where the president's memorandum provided no opt-out language, right? This just said, hey, here's the memo. So effective September 1, employees can do this, even though there literally is. There may not be a logistical way to actually execute it. So we're in this catch-22 world here where we can't guide you as an employer to say, nope, the law says you have a choice to opt out, because we can't find those words anywhere. I have seen other vendors make that claim. We can't find the words. I think they probably are right based on a certain interpretation, but it is not black and white. If you're going to interpret it the strictest sense and literally read the words, then I think it just says employees have the right to do this, which means you got to comply, even though you don't have a mechanism to do so. And I think it's the difficulty of the mechanism to do so. There's this general consensus that you see if you Google this topic. I shouldn't say general consensus. I don't think there is general consensus, but there's probably a majority of people believe that this is going to be optional, and even if there's not a legal stance, because of the reality of trying to implement and the risk associated, the liability associated, many people, including very large employers, have gone public that they're not. Am I characterizing that right, Terry?
You're totally correct. That's exactly kind of where we're at. There's not really a whole lot of information available to us to say one way or another. Again, like legislation indicates that we probably have to participate, but the reality of development and programming and putting it into place, the time that would take, it could make it so that some employers are not able to provide it at all in some cases, much less the time that it might take to develop their systems to be able to support this. A number of questions, again, some of the questions that NPRC and the APA posed to Treasury also requested to have more information regarding whether we had to participate. And of course, our recommendation has been no, please make it so that it's optional for the employer, because not all systems can be developed so quickly to be able to turn around and have this done and have employees recognize this so quickly at the end of year. So you are totally correct.
Yeah. All right, let's jump to question number 2. So how do we pay for former employees that we never collected taxes for? And I'll kind of provide, where I'm going here, but for the audience, I'll kind of back in. So imagine it's January 10th, 2021. And you just hire a new employee. How are you going to pay the taxes that they deferred from their previous employer when, how do you even know if they participated, let alone, you've not collected any taxes from them. So are you supposed to come out of pocket and kind of double dip and pay the employer portion and the employee portion? I mean, how do you do that?
This is one of the big questions that we have posed, and I know NPRC and APA have all recommended to the agency that it not be on the employer's shoulders, that this then becomes an employee 1040 issue. But again, there's no guidance, and so the concern is that based on the presidential memorandum, an employer would be responsible to be remitting that information, whether it's the employees paying their ex-employer to forward this information in, or they're updating the W-4 so that they can tell the employer, hi, I have this additional tax liability that you now need to take out of my check. That's what really remains to be seen. And just referencing the W-4, that could be a nightmare in itself. Hopefully they don't go that way. But the thought process of how would you be able to collect what you don't know from your new employee in order to be able to provide this benefit because they deferred their taxes in the previous year. This is a big challenge because this could impact your payroll systems. And I think as we get into the employee questions, you're going to see even more how this could really impact the employee. It could be hazardous almost to some of the employees' financial health.
Yeah, and you know what, Terry, forgive me, my head's spinning because we've been talking so much since Saturday, trying to unpack the new guidance, and I kind of flipped this question inside out. So I'll re-ask more deliberately, explicitly what the question says about former employees. So let's say I've got John Doe on the payroll now, and John Doe says, hey, I'm going to defer my taxes for the rest of this year because I saw in the news president's executive order said I could. So I do that. And now John Doe, after New Year's Eve celebration, quits, and John Doe is no longer on my payroll. Mm-hmm. So I do have perhaps the properly calculated amount, the 6.2% of the eligible per pay period pays that John Doe got, but now I have no mechanism. I mean, John doesn't work for anymore. I didn't even give me a forwarding address. Yep. How am I gonna? If the law says the employer is responsible for paying, how does that work?
Exactly. And that's the concern we have, because there's the question of how could that employer actually collect those funds from a terminated individual? They have no income. They have no dollar amounts that they can express. So it's that is one of the flip side to what I was referring to, even that the new employee, you've got the old employee. I think I'm jumping questions together, but it is still one of those collection items that I have an employer that in this case would know what the balance is, but I don't have anything to offset it against. So how do I do that? I know that legislation is out there that indicates that the employer is responsible to withhold, and that's the issue that we're having, because potentially, hopefully, they're looking forward to having Congress forgive this amount, but if they don't, one of the employers is going to be held responsible to make this payment, and that could financially negatively impact the employer if they don't have an employee in there on the stick for the money.
Yeah, and there's
Because
so
they
many
could be out.
scenarios.
I mean, thinking in terms of financial, they're out twice. That's horrible.
Yeah, and the number of scenarios this could happen is crazy, right? So there's obviously just natural turnover that happens in organizations. So if you're a small business person, you got 25 employees, if one or two people go, I'm paying an extra 6.2% times a few people. That sucks, but I can make it. What if you're a retailer and 80% of your workforce is in Q4, and by design they don't come back after the holidays? The exposure could just be gigantic, right? Or just some type of seasonal business. I mean,
Yes.
we could be talking pretty big money here. 6.2% of people making less than $4,000 every 2 weeks. That's $100,000 people. I mean, 6.2%. We're talking a lot of money.
Right. And for over a 4-month period, it's a lot. It could significantly be the larger income area for the employer, but it's also the larger tax outbound for the employer. And then to throw it into a first quarter that you wouldn't have those kinds of wages or that kind of tax liability, it could significantly impact the employer and their financial status, because if they are on the hook for this, that could really hurt their bottom line, especially for that first quarter period.
Yeah. All right. So Q3, how will we handle employees whose pay fluctuates? So this one, I think we can probably provide some guidance, right? This is more mathematical based, even though it's complex. So we wanted to unpack it.
Yes, I think for the most part, this is probably not as well. It's still a nightmare in the sense that the issue that you have here is that the employee had more disposable earnings or income in fourth quarter. January 1, we all kick in at the beginning of all of our tax limits. And so then I also have the employee that because of, say, the seasonal work, there was more time, more hours I could get, but then I have a lot less hours in first quarter. You have the employer still dealing with, I have smaller wages that I'm taking out that larger portion of tax. So I could still be on the hook for a big piece, kind of like what we were talking about just a few seconds ago. So that fluctuation could cause a financial impact as well. Again, I'm paying the employee, but I'm paying them less because I'm paying out more taxes already for first quarter. But in addition to that, I have this additional balance that I have to take from their pay, and they may not make enough to make that.
Yeah. And so what would be some help people out? What would be some use cases to think about where this would impact? Ones that jump to mind, I kind of said before, maybe commissioned salespeople whose paycheck by paycheck could vary a whole bunch. Maybe they have a salary and then the last paycheck every month is prior month's commissions, kind of a thing. Maybe it's just hours simply change. Maybe it's overtime. Can you think about any other use cases that employers should be thinking about here?
I think those are the major ones that are the most common. This is just one of those that, again, it's back on the disposable income for the employees. If you work in California and you've already hit your SDI limit, for 2020, you've got more cash, but now all of a sudden I've got Social Security, Medicare, I have SDI coming out of my check, I have state withholding, and now, oh, whoops, here comes that additional Social Security deferral that I had coming out of my check. That makes I mean, if I have reduced hours or the less disposable cash I have, that means that this deferral is going to take a bigger chunk of my living expenses, and that's going to impact the employer overall when he has multiple employees like that. If you have tipped employees and stuff that are really working different items, and a lot of times they have a smaller income because there's less people going out to restaurants to eat or whatever, in that case, if they do that anymore. It's one of those that you have the situation, I've already got not enough wages to make my Social Security, and so I've got adjustments for that, but now I have additional Social Security that I need to pay back from the prior year. That could be really horrible on the bottom line in your payroll.
Yeah, right. All right, I'm going to keep us moving. Question 4. Is there any retroactivity to this as far as we know? So maybe something to put a stake in the ground here. We did get clarification. I don't know that we talked about it at the top, but this is based on pay date, the date of your paycheck or direct deposit, not on pay periods, right? So the pay periods is that ties back to the $4,000 biweekly pay period. But we're talking about, so this takes effect today, September 1st. But that could have, if you got a check today, it's presumably for a prior pay period. Could you bring some clarity to that?
Well, because this is looking at the actual paycheck, and when it's available, that's what they're saying is applicable wages to be able to have deferrals. So you wouldn't be able to defer a paycheck that was for last month. If my check date was August 31st, it's not qualified. The additional piece that we have on this is if the employee opts in after September 1st, he's already received that September 1st check, we might say, you can't go back and defer the taxes that have already been withheld and paid to the agency. So for the most part, it's really based on, when the employee opts in and the paycheck that occurs on or after that date. And again, it still has to be looked at. Each individual check is based on whether their applicable wages qualify that individual for a deferral or not. So again, you might have been eligible on the paycheck before the deferral went into place and not on the next check, which means the deferral wouldn't impact that particular check. But if they opt in, it would go forward, and you wouldn't be going retroactive just based on the fact that you've already collected those taxes. And once they've been collected and remitted, the IRS doesn't look for you to retroactively create a credit. That wouldn't be.
Yeah, right. So
available.
I wouldn't say there's ambiguity. There's complexity at the beginning and the end because the difference between pay period and
Definitely.
check. But it's our interpretation here is that there will not be retroactivity in participation. So if an employee comes to you, early November, hey, I want to go back to September 1st, unless the IRS is going to give you, the employer, their money back, which then it's not even physically possible. And we don't see that happening, right?
Right.
Yeah. Okay.
And for the most part, I think the IRS has indicated the same for the employer.
Right.
Oh, goody.
Yeah. Now here's the biggie. Here's where this all hits the fan, right? So what's the risk? We're not trying to have scare tactics here. But we want to paint a realistic picture of the complexity and difficulty trying to implement this thing. What's the risk if you say no, or risk if you do it and do it badly, or the rules change?
Yeah. For the most part, at this point, I would say that if you don't offer it, we don't know what the penalty could be. I mean, if you've got employees that are asking for it, there's a possibility. We would need more guidance on that. If you offer it and the employee absconds or disappears or whatever, and you don't have it for remittance, we don't know how they're going to handle the employer or what the employer, because the employer obligation at this point is to pay that deferral amount. Penalties and interest for failure to deposit, late filings, and all that other stuff do kick in May 1st. And so whether it's the employee that would take it to the 1040, which that's what we're hoping for, as opposed to making the employer liable, but it could potentially hit the employer, and then you've got all of those wonderful deposits. If you don't make it at the timely pace for repayment between January and April, the exposure is live and it could be big. I believe that they normally would take it, that you didn't make it by April 30th, but yeah, it could be huge.
Yeah, in one way, if they would have said the liability was with the employee, you spit out a W-2 that says this is how much they made, this is how much they should have paid in Social Security tax, and the difference they have to reconcile on their return. But the fact that they said the employer is the one responsible, it just, it's kind of gut wrenching to think about. So again,
definitely.
You can't give legal advice. We're not telling you do not participate or you don't have a choice. There's evidence by the way vendors are behaving that there's not 100% consensus on this topic. But it's clear there are some really big unanswered questions that, if you look at these previous 4 questions, puts a tremendous amount of risk and liability around the employer's neck. So let's jump ahead now and kind of walk through this from the employee's perspective. And a couple of these questions I'll ask, I think everybody already has the answers to, but I think it's almost like in a role play-ish kind of a way important, Terry, because what the goal of going through these is to arm attendees of this webinar for the conversations we expect they're going to have with some of their employees. So whether you love this thing and you want to promote it within the organization and you got a plan, or you hate it and you're just going to have to react to employees that come to you, wherever you fall in that spectrum, pretty much everybody's going to have be at least prepared to have these conversations. So just so you know, that's our intent here. So we know the answer to this one. This is kind of self-evident, but you're going to get this question. Is this all of my taxes? Yay, I don't have to pay any taxes on my paycheck for the rest of the year, right?
I'm rich, yay. 4 months of straight gross pay, right? No, this isn't all of your taxes. The state obligation's still there. The applicable wages that this refers to is basically just the Social Security part. And that's your Social Security subject wages. That does not include your Medicare portion. It doesn't even touch on the federal withholding at this point. So for the most part, it's pretty limited. I think this was just an offer so that it could counter the same as what was offered to the employer. It's only based on the Social Security piece.
Right. So entrepreneurs, business owners, executives of mid-sized companies, the first answer is this is not all your taxes. It's just the employee portion of Social Security, 6.2%. So whatever 6.2% times their income, if it's under $4,000 every 2 weeks, then that's how much money we're talking about. And then the next biggie is this a deferral? Is it going to be forgiven? I saw on the news where Secretary Mnuchin said this is going to be forgiven. How do we advise employers to have those conversations, Terry?
This is the fun one. Basically, the presidential memorandum and the president in his own case is not able to forgive that loan or those dollar amounts. That is an act of Congress, and Congress would actually have to pass legislation that forgives this piece. That's what they're hoping for, but that's not what's in place today. So at this point in time, it is a deferral, which means that the bill will come due unless it's forgiven with future legislation.
So we can have a beer and talk politics all we want on this, and try to try to put our best guess. What happens with the November election for president, and then regardless who the president is, in the outcome, and will the scales tip in Congress? My own personal gut says there's a good chance that whoever the president is and whoever's in control of Congress, they're going to be in the business of trying to help people out, right? So it's unlikely that I should say there's a good chance something might happen, but there's no way for us to actually predict that.
Correct.
Right? And most importantly, as you talk to your employees, the law as it's written says this is an executive order, and the executive branch cannot forgive this. This has got to be an act of Congress. So the answer is no. This is a deferral. This is not forgiven. Could that change? Yes. But this is a deferral, not a forgiven. Anything else you'd add there, Terry? I think we kind of put a bow on that one. Okay. Number 3.
I think we got that one.
Yeah, right. All right. Employee question number 3. If I defer, will I be double taxed in 2021 for the repayment period? And just a reminder, the repayment period was January 1 through April 30th. So what do we say to this one?
It's sure going to feel like it for the employee that actually deferred, because he didn't have the Social Security withheld for those first 4 months. But now that the bill's due, in addition to his regular taxation on that check in January, he's going to have an additional liability that comes out. So he's not really being double taxed. He's paying back what he borrowed, if you would. But the point is that it sure might feel like you're being double taxed.
Now, this one actually gets more nuanced. So we got to get a little wonky on this. So, if I'm $4,000 every 2 weeks, I think it works out to what, $104,000 a year. So if a straight salary person of $100,000 a year, we'll just do that for easy math, right? So they would fall within the threshold of somebody who theoretically could participate. That person is easy, right? So they deferred for a certain amount of period of time. And if their salary doesn't change and they're still employed with you, their salary doesn't change during the repayment period, it's, hey, we forewent 6.2% for 4 months, and then now we're going to kind of double it, and you may as well net it out and call it at 12.4% for 4 months to pay it back. That's clean and simple. But where this gets real ugly, and I know the answers, so this is hypothetical, theoretical, I guess, for you, Terry. What about the employee? So I'm a retail worker. I got a bunch of overtime between Thanksgiving and Christmas, and now my hours are just slashed in January. They kept me on, but my hours are slashed. My paychecks are half what they used to be. How is it 6.2% times that, or is it a per period equal to what 6.2% would have been in my prior period? How do we think about that?
The question is, we still don't have any guidance to tell us how that's going to happen. But the thought process is that the balance that we had deferred by the end of the year is the balance that would need to be repaid. And so if they actually divide it up by pay periods, it could sure look like a lot more than 6.2% coming out of that small check. And having your hours slashed in half and then having like 6.2% of what you were making come out, it's going to be a lot higher percent against, your net. So it could eat up that paycheck really quickly and leave you with a lot less. So it is, not knowing exactly how we have to collect it. Is it 6.2% based on what your wages are, or is it just here's the amount divided by the number of pay periods that you owe and we take it out? It could seem like more than double the tax for your 2021 earnings.
Yeah, and I'm just playing around my calculator as we're talking here, Terry. So like if I was at the top of the scale as making $4,000 every 2 weeks, 6.2% of that is $248, right? Now, if my pay was really cut because I'm not getting the overtime anymore, I'm not getting the hours, let's say I'd be at $3,000 instead of 4,000. So 248 divided by, I mean, you get pushing a 10% tax real fast, right? I mean, if your pay was cut in half, you could be 15, 20% kind of a tax.
Exactly. And that's just for the Social Security portions. You've got to see that the employees also got other tax obligations based on the state and the Fed, his withholding and all the other fun things that could really, really impact the income. And you still also have the situation of based on your income with your W-4 for tax year 2021, what's your tax obligation? Because they're not changing what your tax obligation is going to be for 2021. This is an obligation you're pulling over from a prior year. So that in itself could cause a lot of headaches. That's why this is one of those, an employee really, really needs to think about this for deferring, because you get the cash up front in the beginning, but if it's not forgiven, this could be really painful.
And just for no excuses for sure, this is the boat that so whether you're using, I'll name them, you're using an ADP or a Paychex, or you're using QuickBooks, any software that is going to have to be programmed and developed to comply with this order can't just check a box, create a checkbox for people to opt out of their Social Security tax with that make less than 4,000. That's easy math. But to program software to actually execute this law, it must include the payback, right? And so this question alone, I think, really draws out the huge complexity. And then the flip side, so back to the intent of these questions, the employee questions, we don't want you to scare the heck out of your employees, but you're doing them a good service if you explain the tremendous ambiguity. So if you have somebody who they're hurting, they want and need the extra relief. That's why they're asking for the deferral now. It's a reasonable thing saying, hey, we do not have guidance from the IRS yet about how exactly to implement this, but are you really sure you want to pursue this? Because that means you're going to have everything that you don't pay now, you're going to have to be paying back after the first of the year. And could you survive on those checks? No, times are tough, and we're all in the same storm, not in the same boat. So casting no judgment here, but I think that's a very reasonable conversation to have with employees. All right, let's jump to number 4.
All right.
What if my pay is lower in Q1? So we kind of tackled this a little bit, expounding on the previous question. Anything else you want to add before I go to question 5, Terry?
No, I think you got it. We've pretty much covered this one.
And so the next one, this is where this is where my gut says Congress might act and implement forgiveness, regardless whether the executive branch is blue or red, or the Senate is blue or red, House is blue or red. I think the political pressure will be very high to relieve the burden. There's obviously this very difficult thing that has been written as an executive order, and now we're all figuring out how to implement. And if it leaves a bunch of employees, frontline workers, hanging in the wind, in today's climate my gut says Congress will help. We'll come to the help, because the political fallout of not helping will be terrible. But the way the law is written today, what the heck does an employee do if they can't afford repayment? And I mean that quite literally. What would they do?
It is a challenge. if they can't afford it, that's another item that's going to be up there. And we have to realize too that how fast will Congress work to be able to forgive it? Am I going to have this amount coming out of my check in January until Congress decides to do something in February of next year? I'm already going to be in the hole for 2 months. I could potentially have major issues. The bill, if it's not forgiven, is still there, which means that it could be tacked on to your 1040 in potential situations. You've got the employer being responsible to remit, but the employee doesn't make the money. You've got, it could be major all the way across the board on how this can impact the individual as well as the employer. And the bill is a deferral, so that means that the balance is still going to be due unless it's forgiven. And so that this could be huge. It could mark anybody's financial account with the IRS for the future, just because if it's not forgiven, the bill's going to come due, and penalties and interest will begin on May 1st is what we've got. So this is an ugly situation.
So I think as we kind of wrap and kind of where to go from here, it's obvious there's going to have to be more guidance from Treasury on this, right? This is quite literally a screenshot from whitehouse.gov, the memorandum web page. You can Google it and read it if you want. And this is the section 3 call out is quite literally a screenshot from a section of this page that says the Secretary of Treasury shall issue guidance to implement this memorandum. I think we've probably done an effective job today explaining why it is not possible for any employer. It may be theoretically possible for an employer to comply with the law, but in the same way maybe you did taxes, payroll taxes, in the 80s, using paper and pencil in file folders, and then you could have to reverse engineer and figure stuff out. But there is no way to program software to do things that are yet undetermined. Software is rules-based. Computers follow rules that we program, right? So I think that hopefully what we've tried to accomplish here today is to educate you on the real liabilities that are going to exist for employers who do participate. We're not telling you can opt out. We're not telling you have to do it. We're not telling you can't do it. But we want you to know what you're walking into and what those liabilities are. And then from an employee standpoint, if this is, and forgive me for, if this is a 24-year-old kid who wants to defer taxes to have more beer money for the weekend, have a good, trusted advisor kind of relationship with that employee and say, hey, here's the consequence of that. Can you really afford this in the repayment? And maybe talk them out of it. If this is somebody who is, trying to put food in the family, we're in the same storm, not the same boat, then these are tough conversations. So your liability is very, very real as an employer. Their situation might be really, really tough. All you can do is just have share the information in the most transparent way you can and try to come up with a solution together. There just isn't anything more concrete than that. So what we can commit to you at Assure is that we're working on it. We are preparing our systems. We are doing some programming on the things so we can make some big decisions structurally, architecturally, how we're going to solve this problem. But without all the detail, we can't put out a finished product, nor could any vendor. So we are beginning the process and awaiting more guidance, and presumably we're going to have more webinars like this and more emails updating you to keep everybody up to speed. I would encourage everybody to hop on the website, assuresoftware.com/COVID-19, where we're going to publish more webinars like this, more blog posts like this. We do have other resources, ebooks for reopening your business during the COVID environment. We have a step-by-step guide. You can go field by field, page by page through the PPP loan forgiveness, whether it's the complex original form or the easy form. all kinds of payroll and HR best practices and links to really all the states and major municipalities to understand what's going on for local requirements with your local health departments. So hopefully today was a lot of value. We're in the business of helping more than 60,000 small businesses. Normally, I would say grow, getting the most from your people and developing your people to manage that human capital to grow your business. And today, it's really just trying to get our heads around how do we stay compliant with the law? How do we help our employees get through this so that we can get through this together? So with that, I want to thank everybody for your time. Terry, thank you so much. I always enjoy our conversations. You're so smart, and I appreciate your insights, and I'm sure everybody else did today too. So with that, thank you everyone, and have a great day.